Most small business owners wait 3 months for an SBA loan. There is a newer way to fund your business in 2 days, and it's growing fast for a reason. Did you know there is a financing model that doesn't require a personal guarantee or a credit check? And that companies are using it to raise $25,000 to $10 million without giving up any equity. It's called revenue-based financing, and the global market is projected to hit $42 billion by 2027, up 61% year over year. Today, we are going to walk through exactly how revenue-based financing works in 2026, what it really costs compared to a bank, and the 3 traps you need to know before signing anything. This is a real funding source, not a gimmick, but it works for some businesses and not others. First, here is what revenue-based financing actually is. Instead of borrowing a fixed sum and paying it back with interest, you sell a percentage of your future revenue to a financing company. They give you cash today. You repay it as a fixed percentage of your monthly revenue until a total cap is reached. If your revenue grows fast, you repay faster. If revenue slows, your payment slows with it. There's no fixed monthly payment, no interest rate in the traditional sense, just a multiple, typically 1.1 to 1.3 times the amount advanced. Run a real example. Say your business has $100,000 in monthly recurring revenue. A revenue-based financing company offers you $300,000 upfront with a 1.2 multiple. Total repayment cap is $360,000. They take 8% of your monthly revenue until the cap is reached. If you average that $100,000 per month, 8% is $8,000, so you repay $360,000 over 45 months, roughly 4 years. Now compare that to a bank. A traditional SBA loan at 12% interest on $300,000 over 5 years costs about $98,000 in total interest. Revenue-based financing costs $60,000 on the same amount. On paper, it's cheaper, but the catch is the speed of repayment. If your revenue grows fast, you pay back the cap faster, and the effective annualized cost rises. Here is the big advantage: no personal guarantee, no collateral, no credit check on the founder. The financing is underwritten against your business revenue, not against you. If your business goes under, you don't owe the difference personally. That's the structural advantage over an SBA loan. Now the major players in 2026. Capchase, based in New York, funds B2B SaaS companies with $100,000 or more in annual recurring revenue. Advances up to 70% of ARR. Funding range $25,000 to $10 million per transaction. Approval typically 48 to 72 hours. FounderPath, based in Austin, specializes in bootstrapped SaaS. Accepts companies with as little as $10,000 in monthly recurring revenue. That's $120,000 ARR, lower entry point than competitors. 12 to 48 month repayment terms. Pipe, marketplace model, sells your customer contracts to investors who bid on them. Faster but less predictable than direct lenders. Uncapped, London-based, serves e-commerce and SaaS. Funds $50,000 to $10 million. Requires 6 months of revenue history and $1.2 million in average annual revenue for non-Amazon sellers. If this is the kind of practical funding information you wish you had had earlier, please hit like and drop a comment below. I read every comment and reply personally. Share this with family and friends who need to see this. And don't forget to subscribe, because we put out several new videos every week. Drop a comment if you have used revenue-based financing or you are considering it. Real numbers from real founders help everyone watching. Now who actually qualifies? The core requirement is recurring revenue. Subscriptions, SaaS, memberships, service contracts that renew. Most providers require 6 to 12 months of revenue history. Minimum monthly revenue ranges from $10,000 to $50,000 depending on the platform. And here is how to apply. Step 1. Connect your data. Most platforms integrate directly with your bank account, your accounting software like QuickBooks or Xero, and your billing platform like Stripe or ChargeBee. They pull 12 months of history automatically. No pitch deck, no business plan. Step 2. Get an offer. Underwriting algorithms run on your revenue patterns, customer retention, growth rate, churn. Most companies return offers within 24 to 72 hours. Step 3. Sign and draw. Once accepted, funds typically deposit within 3 business days. Some platforms wire same day. Now the 3 traps you need to know. Trap 1. The effective interest rate trap. That 1.2 multiple sounds simple, but the actual annualized cost depends on how fast you repay. Pay it back in 12 months, and you are effectively paying 20% APR or higher. Pay it back over 4 years, and the effective rate is closer to 10%. Calculate your expected payback timeline before signing. Trap 2. The stacking trap. Some founders take revenue-based financing from one provider, then take more from another, then a third. The combined revenue share starts eating 30 or 40% of monthly revenue. The business runs out of operating cash. Read every contract for restrictions on additional financing. Trap 3. The growth trap. If your business grows much faster than projected, you repay the cap fast. Faster repayment means a higher effective interest rate. Some founders end up paying the equivalent of 40 or 50% APR on what felt like a friendly deal. Always model your fastest possible repayment scenario, not just the average. Here's how to use it well. Use revenue-based financing for things with a clear short-term ROI, marketing campaigns, inventory pre-orders, bridge between equity rounds, specific growth investments, where you can show that the cash will generate enough new revenue to cover the repayment. Don't use it for general operating costs. Don't use it to extend runway because you can't reach profitability. Don't use it as a substitute for fixing a broken business model. The revenue share will accelerate the failure. And one more thing most founders miss. Revenue-based financing is technically debt, but it usually doesn't show up the same way on your balance sheet. That can affect your ability to raise equity later. Some VCS see large revenue-based financing balances and adjust their valuation downward. Disclose every financing arrangement when you raise from investors. Surprises destroy deals. All right, let's lock this in. Revenue-based financing advances cash against your future recurring revenue. Repayment is a fixed percentage of monthly revenue until a multiple cap is reached, typically 1.1 to 1.3 times the amount advanced. Funding speed 24 to 72 hours. No personal guarantee. No equity dilution. Major 2026 platforms: CapChase, FounderPath, Pipe, Uncapped. Each fit different business types. Minimum monthly revenue ranges from $10,000 to $50,000. Maximum advance up to $10 million. Avoid the 3 traps. Calculate your effective rate. Don't stack financing. And don't use it to fix a broken business. If this video helped you, please give it a like and drop a comment below. I read every single one and personally reply to your questions. Share this with family and friends who need to see it, and make sure you subscribe. We are dropping powerful new videos every other day, breaking down strategies most people never hear about. Stay tuned. You don't want to miss what's coming next.